Hi everyone, do you hear my voice? Is my voice clear enough? Okay, so I'd like first of all to welcome all of you. Thank you for joining us. Today I'll be discussing technical indicators um, that can help you in trading in a way that can help you to make money. So technical indicators for me, personally, I would say they are not my main tools to begin with, but rather I would say they are like secondary tools that I could use to read what's on the chart. Okay, but I would never enter the market based on a signal from a technical indicator. This would never happen. So simply put, we would say that technical indicators are secondary tools. They are important, but they wouldn't be our main focus. Technical indicators could be um, leading indicators or lagging indicators based on the time at which they provide a signal. Leading indicators could be called oscillators. And this is where you can insert your indicators. You're gonna open your platform, the MetaTrader 5, and then go to insert. And this is by the way the desktop version. Okay, so you go to insert indicators and then search for whatever indicator that you want. In our case, I want to insert something that is called stochastic oscillator. This is one of my favorite indicators. I believe this is somehow can help you in trading in some certain ways. Okay, so I'm gonna insert it on our chart. Maybe if you want to like use these indicators on your mobile device or whatever, it is the same thing, could be inserted the same way, but the thing is that the interface of the platform on the desktop is not like the one on your mobile phone device. Okay, so you must consider this. So so let me make sure that you are hearing me clearly. Do you hear me, guys? Nice. Okay. So um trading tools, I would think of them as if they are weapons that can help me to win. Okay, think of it as if you are into a match or something like this, and you're going to use everything, all of your power, all the power that you have, so that you are able to achieve success. This is simply what it takes when it comes to forex trading. In a series of webinars, we will provide you with the most important tools that you can use so that you are able to make money from the forex market. Now, as for technical indicators, I talked about them like briefly, but to cut it short, trading using technical indicators wouldn't be our main focus. Our main focus would rather be like how to use technical indicators in some certain ways so that you are able to read what's on the chart very easily. It takes time. It has simply a probability, um, but you must study this technique and try this technique on a demo account first of all, then you can move to a real account so that you are able to make money. You are equipped with this very strong tool from my point of view, something that is called diversions. So just forget technical indicators. I don't care about them. I'm just going to explain one thing, stochastic oscillator, and then I'll move to something that is called diversions. Okay. So when it comes to technical indicators, as I told you, we have two categories. The first one is lagging indicators, and the second one is leading indicators. One of the leading indicators, something that is called stochastic oscillator, or it doesn't have a shortcut actually, but I would call it like stoch, so for just the ease of use. But anyways, stochastic oscillator is the first thing that we're going to start with today. The stochastic oscillator is an indicator that does consist of two lines which move together and interact with each other at some point. In addition, the indicator has an upper and lower zoom. The upper area is the overbought area, and the lower area is the oversold area. Now, some practical examples on this. Look at this. This is the stochastic oscillator. As I told you that it has two lines. It has two lines. Just a minute. Okay, nice. It has two lines. I think I need to like zoom in a little bit. Like, yes, nice. Okay, look at this. It has two lines, two moving averages. Nice. And to the downside, you can find here an area that is called oversold area. This means when the price or when the indicator reaches this area, this simply means that no more traders or no more people are willing to sell this currency pair anymore. So this means that this is a buy signal. So you can go long when the price reaches, or when the indicator reaches this area of I would call overbought, oversold area. On the other hand, if the price reaches 80, okay, this is an overbought area, means no more people are willing to buy this currency pair anymore, or whatever that you are trading. As a result, the price would go downwards, as easy as this. You know what I'm saying? So, in a scale of or maybe from 0 to 100, you're gonna have some numbers here, and within this or inside this window, you're gonna find two moving averages that would go together, would move together actually. So when they reach the area from 0 to 20, this is an oversold area. So this means that you can go long, you can buy. If the price reaches an overbought area, the area from 80 to 100, this means that you can go simply short, because no more people are willing to buy this currency pair anymore, and this is simply a signal that the price would go downwards. I'll give you some examples on this. For instance, this area, okay, when the price here was when the stochastic oscillator was here from 80 to 100, and then it turned down, leaving the 80 area, the 80 level, and the price on the other side was preparing itself to go downwards, and this happened actually. The price went downwards very sharply as a result. Now, this is not something that you can rely on, to be honest with you, because there are many false signals. If you're gonna follow the indicator, you're gonna lose money. I mean, yes, you're gonna make money, but the money that you're gonna lose would be more than what you're gonna make. This is how it works. So this is the stochastic oscillator, simply. This is simply how it is used. Now, relative strength index is another indicator that could be found here as well. Oscillator and relative strength index, the same concept, but it is simply one line. I don't want to go to dive into like calculations and how the indicator was made. And I mean, this is something that has nothing to do with trading. Especially we are just want to take advantage of these indicators, not to study them very deeply in a way that can make us lose our main target, which is making money. So I'm just giving you what's going to help you. Okay, not everything that you might not need. So okay, so let me please confirm that you can hear my voice clearly before I carry on. Nice. Okay. So let's put it this way. Now, forget indicators, forget everything about indicators. This is I'm now trying to um, deliver my experience in a way that can really help you in trading. So I'm not here today to just tell you the theory about what's behind stochastic oscillator and how it was made and so on and so forth. I mean, this is something that I don't like. But what would really help you is getting to know something that is called divergence. I'm going to move to my whiteboard because this is the most important part of the webinar of today. Forget everything else. We're just focusing on divergence. Okay, guys? Okay, so I'm writing here on the okay. Okay, guys, just a minute. I mean, do you see my whiteboard? Okay. Nice. Okay. Just a minute, guys. So there you go. Divergence. Divergence is simply the most important thing that I would rely on when entering the market. One of the things that I would never enter a trade without. Okay. Now, divergence could be broken down into two categories. Bullish divergence, and bearish divergence. Okay. How can we spot divergence? We can spot divergence by using oscillators like RSI, like stochastic oscillator, like OSMA, many things. Give you the structures or the steps that you must follow so that you are able to simply spot divergence. Okay. So now it's all about the pure price action. Now a candle would have four important prices. Would give you four important prices. Any candle, whether it's bullish or bearish, it would usually provide you with four important pieces of information that you must take into consideration. You would usually hear about something that's called high, low, open, close, right? 4 important pieces of information, like a treasure for those who know. High, low, open, close. High is the highest price during the session that you are following. Maybe low could be the lowest price. Open, the opening of the session. Close, the closing of the session. Could be 1 minute, could be 5 minutes, could be 30 minutes, could be 1 day, could be 1 month, could be 1 week. It depends on the chart that you're following. Now, since we're talking about the pure price action, then you must understand that to be able to catch the most important opportunities on the chart, you must just focus on the pure price action. Now, the indicator, any indicator would take its power okay. Any indicator would simply take its power from the pure price action. I mean, high, close, low, open, where those prices come from, they come from how traders behave, right? So this is simply how it works. What we're going to do is that we're going to be watching the price. Say that this is the price of the Euro USD. It's going up, going down, going up, down, and so on and so forth, just like this. On the other hand, you're going to find that the indicator is following. It must follow the price. Okay, nothing wrong with this. What happens here is when the price, when the indicator is not following the price, here comes what we call divergence. So as you can see here, we have here higher highs, look at this. Now the price is making a peak here, nothing wrong with this. The indicator is making a peak. Nice. The price is making a peak, the indicator is making a peak. Oh, but here you're gonna find something that is really strange. Here is you're gonna find higher high, and here you're gonna find lower high. Having this pattern on the chart means that the price must, that the indicator must follow again the price, and this means that the price would go down. So this is an opportunity where you can go short. This would be a great opportunity if this could be found just below a resistance level. If you could find something like this below a strong resistance level, this is a golden entry point. A golden, and I know what I'm saying. This is a great golden entry point. The same thing could be applied on lows. If you have like lower lows and higher lows, there is a difference. Okay, they are different when it comes to lows. The direction of the lows are different. So when there is a difference, in this case, you know that the price would go upwards. So this is a golden buy opportunity. See? Okay. I don't want to make this webinar very long, so I'm gonna show you the patterns of divergence and give you some practical examples, and that's it for today. Okay. Okay. Please confirm that you can hear me clearly, guys. Okay. Mm, just a minute. Okay. Now it's all about bullish and bearish. So bullish. Mm, okay, let's put it this way. Bullish. This is bullish and this is bearish. Nice, nice. Please focus on this. This is going to be very, very important. Okay. Now, look at this. It's going to be something that looks like this. Okay. Here is price. Here is indicator. Show the shortcut. Price. Okay. Now look at this. If the price is making something that looks like this, okay, the indicator should be making something that looks like this. Here you have lower lows and higher low. Okay, this is called bullish divergence. And in this case, you can go long. In this case, you can go long. See, it takes 2 points on the price, 2 points indicator. See, bullish divergence must be focused on lows. The price shows that it is going lower, lower, lower lows, and the indicator is showing higher lows. In this case, you can go long. This is a strong buy signal. What else? You could have like something that looks like this. They could be two points at the same price level. and the indicator is showing like it's showing something that looks like this. So in this case, you can go long. This is okay. This is also okay. What else? We could find something that looks like this. The indicator, the price is showing like lower lows, and the price is the indicator, sorry, is making equal lows. Look at this. Just like this. Finally, here comes something that is called hidden divergence. That is when the price is making higher lows, the indicator is making lower lows. This could also be a divergence. It's called hidden divergence. You can use this, nothing wrong with this. Okay. The difference between the regular divergence, the first one, and the second one is that the hidden divergence would be a continuation signal. On the other hand, the regular divergence is simply a reversal. Okay, a reversing signal. Okay. Bearish. The bearish one would be higher high. This is in highs. Okay. Just like this. This is the another type of divergence. Just like this. Almost at the same level, but here higher, lower. The last one is just like this. Now you can take a screenshot from this explanation so that they can have a reference later. Okay, so all you're gonna do is that you look at the chart and see what we have. Now I'll go back to my chart and see what we have. You can use either stochastic oscillator or RSI or something that is called awesome oscillator. You're gonna find insert, you're gonna find it here, insert indicators, Bill Williams awesome oscillator. When I have this indicator on the chart, I just remove these ones. I don't need them. I just love the awesome oscillator. Now look at the chart, try to find any kind of difference. Okay. Any kind of difference on the chart. Okay, look at this.
Yes, sir. Between 7th September and 19 October. I'm
Yes.
sorry, between 27 September and 19 October.
Okay, this period, I'm going to check it right now, but let me show you something here. Look at this. This is considered to be a bullish divergence. It is not an easy thing to spot divergence easily because it takes time, because you must have like trained eyes so that you are able to spot it when you look at the chart. All you're gonna do, I'm going to show you some more examples, but you must understand something that is really important, that to spot divergence and to find divergence on the chart doesn't mean that you can enter the market right now. It doesn't mean that you can enter the market right now, because you must spot this divergence just below or above a support or a resistance level. Other than this, I wouldn't depend on divergence. I wouldn't really depend on it. Look at this here. You were saying you were talking about a kind of divergence that you could found on the chart, right? Okay, can you repeat what you said?
I didn't hear you, sir.
Okay. Okay. So, maybe the screen is not clear enough. It's not close enough. Look at this one, and this one. Now, as for this one, I would enter the market. Why? Because look at this. Here we had a strong support level at this very point, as you can see here. If I draw my Fibonacci, okay, this is nice. Look at this area of support. Look at this area of support. Now we had a bullish divergence here. The market went upwards. Now this is not really one of my best choices, but it works. Nothing wrong with this, since there's a strong support here. I can still depend on it. But when there is a shape that looks like a U shape or something like this, I can enter the market after then. Okay, is this a divergence? I'm going to show you something here. This red, this below line, is this a divergence? What do you think? The blue line.
Yes.
Okay, so tell me why this is a divergence.
Because it has a higher high.
Mm-hmm. Yes, higher highs. Yes, there's a higher high here, but the divergence is all about that there is a difference between the price and the indicator. So when the price is going higher, if there is a higher high on the price, the indicator must show lower high. But as you can see here, it doesn't go this way. The price is showing higher highs, and the indicator is showing higher highs as well. So there is no difference. So there is no divergence. You know what I'm saying? The divergence comes when there is a difference between the pure price action, the price action, and an indicator, an oscillator. So look at this. Here, for instance, as you can see, here, the price is going higher. The indicator is going lower. There is a difference. There is a divergence. Here, for instance, the price is going lower. This is lower, lower low. The indicator is making higher low. In this case, yes, there is a divergence. Why? Because there is a difference between the movement of the price and the movement of the indicator, because the indicator must follow the pure price action. If this does not happen, there is a divergence, there is a difference, there is an opportunity in the market that I can take advantage of. Okay, so the same thing goes here and here, but here the price is making higher, is higher high, and the indicator is higher high. No difference, no divergence, no opportunity. This is how it works. The opportunity comes when there is a difference. Other than this, just forget it. You know what I'm saying? So more examples on this. Okay, I'm gonna ask you one more question here. Look at this, here and here. And by the way, the point itself, whether this is a low or a whether this is a low or a high, it must meet the same point on the other side. Like here on the indicator side, you're gonna find that there is a low. There must be a low at the same place on the price side. The same goes here. We have a low. The same thing could be must be found here as well on the price side, the price part on the chart. Okay, so here we have lower low and lower low. Is there a divergence? What do you think?
No, because there's no difference between
Yes, between between the pure price action and the indicator itself. This is what I wanted to hear, right? So as you can see here, okay, here, what do you think of this one? Look at this, and look at this. What do you think of these two ones?
there is a divergence.
There is a divergence, yes, because the price is going lower. There's a lower low, and the indicator is going higher low. So in this case, there is a divergence. It's a bullish divergence. You can go long. That's it. Let's try to find another opportunity. I mean, I haven't prepared for it. I'm just trying to pick what's on the chart front of you so that you are able to see how easy it is. Okay. It just takes some time so that you are able to spot the divergence easily. Look at this and look at this. Easy. Yes. So there's a difference here. There is a divergence here. The price is going higher highs, and the indicator is going lower highs. That's it. So there is a divergence, a bearish divergence. You can go short. That's it. Now this would be much better. This would be a great opportunity if you could find the divergence. If the divergence like has showed up just below a resistance level. Just below a resistance level, this would be a great opportunity that you can use to enter the market. Or maybe below, below a resistance level or just above a support level. Okay, for instance, another opportunity here. Okay, here, what do you think of this one? Is there divergence?
No, there is not. There is not.
Exactly. So I think you fully understood this. What else? Yes, look at this here and here. Is there divergence?
Yes, sir.
So it is just as easy as this. It might take some time from your side so that you are able to perfect the process of spotting a divergence on the chart. It will take time. Nothing wrong with this. You must have trained eyes so that you are able to spot this effortlessly. Just take your time, open a demo account and try this yourself. If you have any questions, maybe it's your turn now to ask me questions, if you have any.
Sir, I have a question. Divergence is not the only thing that we will depend on, right?
Yes, divergence is not the only thing that we could depend on, but the thing is that in a series of webinars that we provide, we will just like we would explain each tool on its own on each webinar, so that by the end of these webinars you are equipped, you have the weapons, so that you are able to trade yourself effortlessly. So I'm not going to say everything in this webinar. This is one tool of many that will be explained later.
Okay, sir. Thank you.
You're welcome. By the way, you have I think the sales department would give you like a link for our recorded webinars. We have previous webinars. You can watch them again in both Arabic and English. Pick whatever that you want, and you can get in touch with us anytime that you want. If you have any questions in the future, just let me know through the sales department. They are very helpful. They would help you to get in touch with me. If you have any questions, I'll be more than happy to help you. So that's it for today. I hope that you have enjoyed the webinar today, that this webinar is beneficial to all of you. Thanks, guys, for watching us. Thanks for being there. Stay tuned for our upcoming webinar, and bye for now.
Thank you so much, sir. The webinar was amazing. Thank you. I will contact you on WhatsApp.
Thank you. You're welcome. You're welcome.